Understanding the basics of nonprofit accounting is critical when you're starting or leading a nonprofit organization. Now, I've certainly done my fair share of nonprofit accounting, but I am not an accountant myself. That's why for this Changemaker Cafe episode, I've invited a real nonprofit accounting expert, Pablo Centeno of TELOS CPAs, to talk us through 5 foundational nonprofit accounting terms that you need to know to start learning how to manage your organization's finances effectively. For each, we'll explain what it means, why it's important, and how to use it. Don't forget to subscribe to the channel for more content on nonprofits, fundraising, and more. Let's go. Accounting is more than just background administrative work in nonprofits. It can really help your organization strategize around fundraising, see if you're headed for financial challenges, and helps you stay accountable to the public. But if you don't already have a business or accounting background, wrapping your head around some of the terminology can be a lot. One of the most important concepts to understand in nonprofit accounting is functional expenses and functional expense allocation.
My name is Pablo Centeno. I'm a CPA and founder of TELOS CPAs, teloscpas.com. We focus on non-for-profits, mostly 501c3 charities, and I'm very happy to be here and help as much as I can. One that is almost new for everybody is functional expenses or functional expense allocations. Basically, when you're going to allocate your different expenses into like program management, which could be things like if you have a CFO and you pay them a salary, or anything like accounting, things like that will go in that bucket. You also have fundraising. Every time you're spending money to try to fundraise, you'll put that in there. And it's important because as the organization grows, your Form 990 for the IRS will actually ask for that information, and they will ask you to break it down in those buckets. And it is a red flag when you have like everything in one column. So it's clear that it wasn't allocated correctly.
All right, let's unpack this. As Pablo was saying, nonprofits allocate their funds and expenses into 3 functional expense categories. You've got programs, management and administrative, and fundraising. You've got to keep your receipts and expenses categorized in this way because every year the IRS will ask you to file your nonprofit's annual tax forms and provide the breakdown of how your expenses fall into each of these 3 categories. But one thing I did want to add here, because this comes up a lot in questions that even I get from you all, that is how to categorize paid staff time. A lot of people have this misconception that all paid staff of any kind would fall under the category management and administrative, but that's not actually true. Instead, you'd classify paid staff salaries based on how they're spending their time. So a program manager overseeing your nonprofit's programs might spend 100% of their time on programs, so 100% of their salary would be classified as a program expense. An executive director might spend 40% of their time managing, 30% on fundraising, and 20% of their time supporting programs. So you would divide up their salary as expenses by those same ratios: 40% management, 30 on fundraising, 20 on programs, and so forth. All right, let's talk about another one. One of the terms people misunderstand the most in the world of nonprofit accounting, according to Pablo.
Another one would be the restricted contributions. It's kind of confusing for some people because they can think of it as like restricted as like I don't have access to it, or money in the bank. But at the end of the day, what it really means is that the donor that made the contribution, they gave an explicit or even an implied restriction on that donation. The IRS is trying to protect people, the donors, and so not abiding by these restrictions could put your tax exempt status at risk.
Wow. Okay, let's go a little deeper into this. Basically, as Pablo was saying, when a donor makes a donation, they have an option of telling your organization, I only want you to spend this contribution on this specific program, or to buy your organization a new printer, or any number of things. And your organization has 3 choices when this happens. First, you can refuse the donation. Let's say the donor wants you to spend money in a way that your nonprofit doesn't actually need. Two, you can try to talk to the donor and ask if you can spend it in a different way, more in alignment with some other need. Or three, you can accept the donation and plan to spend it how the donor says. You're going to need to track which donations are restricted in this way by intended purpose in your accounting software and be able to prove that you ended up spending it that way to the IRS if needed. The most important thing is transparency and good communication. So, you want to make sure when you put donation requests out that you are clear about whether the money will support a specific program or project or the organization's operations in general.
When it comes to doing proper accounting, it's very important if you're thinking of later maybe needing an audit. There are other ways where a contribution could be restricted. You could be making that contribution to be restricted without knowing. So, for example, a common one is advertising. So let's say you send a flyer and then instead of saying, hey, we need money for your mission in general, you start by saying like, we need this building built for sheltering more dogs. And then you just ask for money. You're actually implying that all donations will go towards that. And so anybody that donates that money is technically giving a restricted contribution for that building. So that's something to keep in mind. It doesn't have to be explicit. It can be implied, that restriction. Sometimes the nonprofits are the ones that create that implied contribution without really knowing. So just something to keep in mind and do some research if you're in fundraising.
It's also important to understand how to assess the financial health of your organization, the resources you have available to cover the costs of your programs and operations. So that's where understanding net assets is important.
Another one would be net assets, which for those that kind of understand a little bit of the traditional business, how you have your assets, your liabilities, and then your equity. Well, nonprofits are not owned by anybody. They're run by the board of directors. So instead of equity, we just call it net assets, and those would be separated into with donor restrictions or without donor restrictions.
So, as Pablo pointed out, in a business, net assets might be the equivalent of equity, but nonprofits don't distribute equity to shareholders, and nonprofits don't even have shareholders. So, that means net assets is the amount of resources available to reinvest into the organization's mission after liabilities or current expenses and any upcoming debt or owed money are subtracted from your organization's assets, cash and value of any assets owned by the organization. And going back to restricted contributions, some of those net assets might be restricted also, which means that they aren't actually available to spend on anything the nonprofit needs, but only specifically on what the donor asked for it to be spent on. But what if your donations to your organization aren't money?
In-kind donations are basically any non-cash gifts. So that could be goods or services. It can be the value of a building that you don't have to pay the lease on. So the person is technically donating the lease for you. So there's a value there.
But there are some special nuances when it comes to documenting in-kind donations. For example, what services count as in-kind donations and how do you record these donations since you don't have a typical receipt for a purchase like you would when your nonprofit buys something?
If you're in any of the Facebook groups related to nonprofits, you'll see a very common question about, can I record this service, this donated service? We get a lot of volunteers, and that's where a lot of people kind of get confused. What services should be recorded as in-kind donations versus just volunteering hours, which are not recording in accounting. For services, there's three main points I like to keep in mind or to tell people before you go and record that donation. Number one is it has to be a specialized skill. So think about accounting, legal, things like that. Then the person giving that service needs to have that skill. So an accountant doing accounting, that's good. But if just your cousin happens to know accounting and they go and do the books for you, but they're not really an accountant, they don't have the experience, that doesn't really qualify. And then number three would be you have to make sure that it was something the organization was going to need anyway. The organization would have to pay for it regardless. So if those three things are met, then you have an in-kind donation of a service. When it comes to any other gifts, a common one is cars. Depending on the value of the car or the item donated, if it's something large, it might be worth seeking a little bit of assistance, because the way this needs to be reported is by the fair value of the donation. In the scenario where that organization may need to go through an audit, they are going to need to show how they came up with that fair value. And there's correct ways to do it and incorrect ways to do it. In general, what I'll tell you is just try to find with the market values. Let's say, example of a car, go to Kelly Blue Book, put in the information for the vehicle, go into similar websites, just get as much as you can to come up with the similar value. But again, when possible, just try to find some guidance, and we can, or any accountant can just help you come up with that fair value. It's just one of the services we can help you with.
Now, before I share our fifth and final nonprofit accounting term, let's take a moment to thank the sponsor of this video, Click and Pledge. Before you even have any revenue or expenses to document, you need to do some fundraising. And for that, you need a fundraising platform that can help you collect and track donations easily. With Click and Pledge, you'll get a robust dashboard where you can plan out your fundraising campaigns and monitor your progress. You'll get highly customizable donation forms, in-person fundraising features, text to give, peer-to-peer fundraising that allows your supporters to go out and form teams and raise money from their networks, video fundraising with donation links embedded directly in the videos, donor outreach tools, which are so important to improve donor retention, a complete Salesforce integration, lots of other integrations, and more. Some platforms charge more based on your organization's size, but not Click and Pledge. Their pricing is going to stay the same even as your donor list increases. And I know nonprofits really appreciate how there are no contracts and all of their solutions are included at no extra cost. You can learn more about Click and Pledge's fundraising solutions and get your first $25 monthly fee waived using the links below this video or these QR codes here. You can also get in contact with their team and ask questions or schedule a demo, or sign it up and give it a try right now and let me know what you think. All right, so far we've covered functional expenses, restricted contributions, net assets, and in-kind donations. But there's one big one we haven't touched on yet that impacts how you set up your entire accounting process from the beginning. The two most common accounting methods used by nonprofits: cash accounting and accrual accounting, each with their own processes for documenting revenue and expenses and with their own benefits and pitfalls.
When it comes to nonprofits, it gets a little tricky. Cash accounting basically means that every time cash goes out or it comes in, that's when you record your revenue or your expenses. And the accrual accounting part, which is instead of recognizing an expense or recording revenue when the cash is received, you will do it when the revenue is earned or when the expenses actually being incurred. So the example with insurance, you grab those $10,000 and then you're going to put it on a prepaid account on the beginning of the year, and then you're gonna kind of amortize it or just kind of break it down for the rest of the year. Every month you'll take a little bit towards the expense, and then the rest will sit in the balance sheet. So think about prepaid accounts or some of the liability accounts like accounts payable. That will be a sign of accrual accounting. It's best in my opinion, for nonprofits to try to start from the beginning with accrual accounting. But if it's not something you are familiar with, you don't have somebody do it, you don't want to spend the money, it's totally acceptable to do cash accounting at the beginning and then just transfer later. But as the organization grows, and especially when you start applying for grants or things like that, you're most likely going to want to present accrual accounting of financial statements.
All right, what did you think? Which terms did you know already? Which ones were new to you? I'd love to hear your thoughts. What questions do you have about these? Leave all that in the comments below. And of course, I'm going to leave Pablo's website in the description if you'd like to connect with him. Don't forget, you can always get more content in my weekly newsletter and more resources on my website, changemakercafe.com. Be sure to subscribe to this channel so you don't miss our next episode. I'm Amber Melanie Smith, and I'll see you next time.